Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey, everybody. Welcome back to another episode of Retirement Rescue Radio. I'm your host, Nate Miller. And today we're going to be going over something that, as you know, I go through all of my meetings that I'm having with clients or with prospective clients, just y'all retirees that are out there. Sometimes questions come up and I'm like, that would be a really good podcast episode, because if that person has that question, chances are there's a lot of people that might have that question, especially if that question comes up multiple times in a short period of time, then that's probably going to be a good podcast episode. So today we're actually going to go, I know we did an episode here recently on annuities as an asset class here just a couple episodes ago. And today we're going to continue talking about annuities, because one of the questions was, there was someone who came in and they had a few different annuities with different crediting strategies. What the heck is a crediting strategy? For those of you that have not, that don't have any annuities and therefore maybe never heard the term crediting strategy, it is how the insurance company actually credits interest to your policy. It's how you make money. That's the bottom line. It's how you make money inside the policy. That's a crediting strategy. And he didn't really understand all of the different crediting strategies that he was in, nor especially all of the different crediting strategies that were available on the different annuities that he had. And so today, what we're going to do is we're basically just going to go through some of the normal crediting strategies that you're going to run into in annuities. Therefore, you can figure out how you're actually going to make money in your annuities, with and specifically in the fixed indexed annuities. So the fixed rates annuities, that's pretty simple. If you're making 3% for 5 years, easy math right there. It's like you got a 3% compounding growth every single year for 5 years. That's pretty simple. You don't need to worry about crediting strategies or, explaining or doing a whole lot of math. In that case, it's just 3% every single year. Boom. It's very predictable. Variable annuities, they're basically in sub accounts, which you think of that like mutual funds within an insurance company. And so those little sub accounts can go up, they can go down, and you can watch whatever those investments are. And boom, there's no floor of zero like there is in fixed indexed annuities. So with the fixed index annuities, we're going to go through those different crediting strategies. And I'm also going to use my iPad to draw. So for those of you that are just listening to this, if you wanted to go over to our YouTube channel, Retirement Rescue Radio, go ahead and hit the subscribe button, smash the notification bell. You can always be updated, but you'll also be able to see what I'm going to be writing on my iPad as we go through this, because I think you'll still be able to get a good idea of how these work without the visual, but I always feel like visual just adds another layer to the learning. And so we're going to do that here real quick. I'm going to go ahead and share my screen via AirPlay and then set it up here. Maybe. Oh, I got to hit the share button first. Okay. Oh, it's saying I need to install a plugin. That's like the 5th time I've needed to install a plugin. Okay, let's try that again. Okay, there we are, and bam. So hopefully now you are looking at a blank white screen, because that is what you should be looking at. So far, my iPad is blank. So the very first crediting strategy we're going to go into is probably, and I would say maybe it's one of them that we've seen most often, and it is going to be an annual point-to-point with a cap. Annual point-to-point with a cap. Now, this could be annual. This could be every 2 years. This could be every 3 years. So it all just depends on what that term is. And for this example, we're just going to use annual point-to-point. Okay. So annual point-to-point with a cap. And let's say that is going to be tied to the S&P 500. and that cap is going to be 5%. Okay, so now what does that mean? Whenever you hear the word cap, that means that whatever that cap is, that is the most that you can earn in that policy during that term. So in this case, the term is annual. So in 1 year, the most you could earn on this would be 5%. So that, and it's tied to the S&P 500 index. Now there's a lot of different indexes. There's S&P 500, Dow Jones, NASDAQ, S&P low volatility, S&P multi-asset risk control. There's JP Morgan indexes. I mean, you name it. There's lots of different indexes out there, guys. Indices, I believe, is the right term to use, but we're not that fancy here. So S&P 500 5% cap. So what does that mean? That means if the S&P over that year, and that's contract anniversary to contract anniversary. So it's not January 1 to January 1. If you got into this policy April 2nd, well, then it would be April 2nd to April 1st of the next year. That would be the year for that policy. Okay. So it's contract anniversary to contract anniversary is that annual term, or 2-year term, 3-year term, whatever it is. So if the S&P 500 did 10%, you're only getting 5. If it does 20%, you're still only getting 5. If it does 2, you get the full 2. If it does 5, you get the full 5. If it does 6, you still get 5. Right. And so that means that's it. That, the most that you can possibly gain is only going to be 5%. And so that, honestly, we don't really like those very much because having the cap limited to 5%, well, that means in years where it's down, well, yeah, it's an index annuity, so you're not going to lose anything, but that means that your average is always going to be less than 5 because there's going to be negative years. And so at a 5% cap, that doesn't really allow for a ton of growth potential. So we don't necessarily tend to like products with caps unless those caps are pretty darn high. If that cap happens to be 10%, or 11%, we're okay with that. We are definitely okay with that. But down at like 5%, 4%, 3%, some of the caps that we're seeing right now, especially with the recent volatility of the S&P 500, we're not going to be really too excited about those caps right now. And here's like, I'll kind of fast forward and give you a little bit of perspective of why we're going to be going over this as well, because knowing these, and especially from the agent, the advisor's standpoint here, understanding all of the different indexes, all of the different crediting strategies can help, because the rates can change from year to year based on whatever the market is doing. And so having a good understanding of when to use particular caps or particular crediting strategies is important, right? Because that can help or hinder the amount of growth potential inside your annuities. So annual point to point with a cap, S&P 500, 5% cap, boom, 5%. That's the most you can get. Okay. Now, the next one we're going to go through is going to be a monthly point to point. What is a monthly point to point? And that usually is also going to have a cap. And that is going to be expressed as a monthly cap, not an annual cap in most cases. Once again, I'll just use the S&P 500 as the example. And let's say we've got a 1.5% cap, 1.5%. And once again, that's going to be based off of the contract anniversary. So once again, if you got into it, say May 1st, well, that's going to be May 1st to April 30th. So you're May 1st to May 31st, excuse me, that would be the first month. And then you've got June to June. So you see how that works? Or if it was May 15th to June 14th, that would be the first month. So they're going to do a 12-month cycle, right? And every month, the most you could make is 1.5%. And so if you do the math on that, there's 12 months in a year, 1.5% cap. If the market just went straight up every single month, well, then that means that's a total of 18% that is possible for you to be able to make inside this in 1 year. 18%. That is your maximum possible. Now, that sounds really good until, and by the way, monthly point to point is also sometimes referred to as a monthly sum. So let me write sum. And why is it maybe referred to as a monthly sum? Well, you'll see how we figure the interest is adding stuff up. That's why it's a sum of data points is really what it is. And so what that means, let's say month number 1, the index, the S&P goes up 2%. Awesome. Well, you only got 1.5% of that. So 1.5 is what you got that time. Next month, it goes up 1%. Well, you got the full 1%, right? Next month, it's up 1% again. You got 1%. Next month, it's down 3%. Well, you got 0. But here's how this is working. Actually, let me erase that. It is also -3 because it's a monthly sum, right? So we still got to go down 3. So that's why this is where I want to say the negative aspect of this crediting strategy comes into play. There's a cap on the upside every single month, but there's not a cap on the downside. And so one bad month could basically erase a lot of positive gain. And so let's go through a scenario here. So let's go up another 1% plus 1, right? And then we'll go -4%. So we got a net 4%. How many is it? 1, 2, 3, 4, 5. Let's just go 6 and call it. Wait, 1, 2, 3, 4, 5, 6. Okay, yeah, let's just go 6 and call it 12. Okay. So let's add these up. All right. So we're going to add these up right now in the bottom one, not the top one. Because remember, the 2%, we're capped at 1.5. So we got to just use 1.5 there. So 1.5, 2.5, 3.5. Oh, down 3. So now we're only positive 0.5. Up another 1. So now we're 1.5, but then -4. So now we're in negative territory. So if the index ends negative for the entire year, so let's just say it does that again for the next 6 months, right? So if it's negative, then what you actually get credited will be 0 because you still can't lose anything. So if it's negative, you get credited 0. If it's positive, so let's say we end up with a positive 3% after we add up all of those, well, then boom, you got a 3% growth for that year. So you can see how a couple bad months can really wipe out a lot of the gain in a monthly sum if there's a really low cap. Once again, if there's a good sized cap, once you really start getting around 2.5% on your monthly cap, you can start getting some really good gains and don't have to worry as much about a big drawdown wiping out as much of the gains because you got more each month that it was credited. So that's monthly sum. And all of these are affected by interest rates and volatility. So if there's a lot of volatility, we're going to see lower caps. If there's if the interest rates are low, we also might see lower caps. If there's low volatility, we can see high caps, very high, right? And not only that, we might even be able to see some uncapped things, which we'll get to those here in a second. So monthly point to point with a cap, there we go. Now monthly average. And most of these monthly averages are going to have some type of a annual cap, right? So it's a monthly average with an annual cap. That sounds extremely confusing. What the heck does that mean, Nate? Well, first off, how is monthly average figured? Okay, so there we're not looking at the percentage gain or the percentage loss every single month. What we're actually looking at is the index value. So once again, if we're using the S&P 500, let's say the index value month number 1 is going to be 4,000, right? It's kind of up around 4,400, I think, about a year to when we're recording this in late July. It is late July already. Wow. Oh my gosh. All right. Oops. Get back down. There we go. Okay. So 4,000, and then month number 2, maybe it's 4,100. Month number 2, it's 4,050. It went down. Month number 3, it happens to be 3,995. Month number 4, back up to 4,100, and then say 4,150, 42, 4,150, 42. 1, 2, 3, 4, 5, 6, 7, 8. Let's say 4,250. 4,250, and let's just say 4,250 again. It just kind of went sideways there for the last 2 months. All right. So now I might just press pause and add that up here for you real fast. Maybe not. Maybe I'll just do it. So anyway, so what you'll do is you'll add each one of those up and divide by 12. So that's where the monthly averaging comes into play there, guys. Bear with me while I'm going through this. This is where you can talk amongst yourselves for a little bit here. 4,200 plus 4,250. All right. Oop. There we go. Divide that by 12. 41.41 and a quarter. Okay, 41.25 is what that ends up with. Well, what is that over 4,000? About 3.5%. Okay, so 3.5%. Well, let's say that annual cap happened to be 5%, just like the annual point to point. Well, then that means they get 3.5% credited to the account because that was the average. What if that had been about, 4,500? So 4,500, and that's that's a 12.5%. So if 4,500 was the average at that point, then that would be 12.5%. But if they had a 5% cap, they still would have only gotten 5% total. So hopefully that makes sense, especially if you're watching it on YouTube. So that's how the monthly average with annual point to point cap, with annual cap works. Now, next one we're going to go through this is where they start to get a little bit more exciting. So what we've been talking about so far is caps. So basically they're limiting how much you can gain. It doesn't matter what the market does. We could be on a tear and you're still only going to get a specific amount, a specific cap, and that's it. Not too excited, especially right now when we're looking at some of these caps on things. Not too excited about those caps. And so what we're really more excited about is the uncapped crediting strategies. All right, because so the uncapped crediting strategies, we're going to start with something called a participation rate. And what the heck is that? Well, think of it as the rate in which you participate in the gain, right? So what percentage rate are you going to participate in whatever gain happens in that index, right? So once again, let's use S&P 500. S&P, not S&5, S&P 500. And you're going to have a 50% participation rate. Now, by the way, that is a very good participation rate on the S&P 500, 50% participation rate. All right. So what that means is if the index, once again, they look at the beginning of the year and the end of the year, once again, on an annual point to point, or annual, this is an annual point to point. Okay. And once again, you can have 2-year point to point, 3-year point to point, and it's just going to be a little bit different. Usually the trade-off for waiting a little bit longer to have it lock in is you're going to have a little bit better rate. So in this example, let's say the annual point to point participation rate is 50%. Let's say the 2-year point to point, if you're willing to wait 2 years to have it lock in, that might be a 60% participation rate or a 70%, depending, right? 3-year, you're going to have another larger percentage rate that you could possibly have. Sometimes that's the trade-off and leads to some pretty strategic crediting strategy choices whenever we're choosing crediting strategies based on those, better rates sometimes. So S&P 500, 50%. Well, that's easy. If you look at the S&P on your contract anniversary date, and then 1 year later, what is the index? And then what is that percentage gain? That's it. So if it's 50% and it was a 10% gain, well, then 10%, 50 of that equals 5% gain. If the index did 20% that year, guess what? You're going to get a 10% credit. You just made 10% in a product that can't lose money in that case, right? So that is the participation rate. That participation rate can be very, very low. That participation rate can be very, very high. All right. So there could be, let's say on another index, let's call it the, well, we don't even need to call it an index. Let's just say index number 2. All right. Because there's a lot of them out there. Let's say that participation rate happens to be 90%. Well, that means on that index, you get 90% of it. So if it does 10% in that year, you get 9%. If it does 20%, you got 18%. So right off the bat, that sounds way better than the 50% on the S&P 500. So why would you choose one participation rate? If that participation rate is higher, why would you ever want to choose a lower participation rate? Well, that could be all about the index itself. Some of these indexes are extremely volatility controlled, to where maybe that they're basically built to make 3, 4, 5, 6% per year. Well, if you've got 100% or 90% of 6%, maybe 50% of 20, right, is better than that. But once again, we never know what the index is going to do. Really, from one year to the next, it could go up, it could go down. We could choose right, we could choose wrong. And so that there could be some instances, though, where we would want to have a lower participation rate, because we know that the index probably that year, maybe there has been a big down year in the S&P 500, and the way that the contract timing is, the anniversary happens to be when it was way far down. So like, let's just use the example of the S&P with the coronavirus. Here in March, when it tanked in 2020, completely tanked, the S&P went down a lot, right? Well, if there were some contracts that renewed at that time, well, they maybe didn't get any interest credited for that year because the market was way down, but now they're going to reset at that lower index rate. So any growth from that lower spot now is going to shoot up. And so if they're able to have even a lower participation rate, but maybe on the S&P 500, that could do better than a volatility controlled crediting strategy with a higher participation rate. Hopefully that makes sense, because maybe that higher participation rate in that other index maybe is only going to do 6 or 7% that year, where the S&P might do 20 because of where it was before, because there's a good chance a year later it's going to be able to regain quite a bit, historically, quite a bit of that initial loss. So it's just kind of all about, once again, we look at these every single year. So participation rate. Now we're going to start getting we're going to start combining some of these, because you can combine any of these. You could have a participation rate with a cap, right? Maybe you got a 90% participation rate with a 10% cap. Maybe you got something like that. And you could. Oh, we don't see a whole lot of those. But we're going to start going over a few other terms. Oh, actually, also, guys, you could just have a fixed account. There are fixed accounts inside these fixed index annuities. But honestly, I don't know why anybody would want to use them because the fixed rate in these is usually not as high as what I mentioned in a traditional fixed annuity. So if you get a fixed annuity paying 3% for 5 years, you know exactly what it's going to return. Well, in the fixed index annuities, you're trying to go for more growth, and most of the fixed interest rate crediting strategies don't have very high interest crediting rates. So if we had a, say, 3% on a 5-year, well, these might be 1.5%, 2%, maybe is what they're going to be paying. So just, it's not nearly as high. And in my opinion, if you're already trying to, you've got the floor covered, so you're not going to lose anything, you might as well try to get a little bit more growth in those accounts. So participation rate. Now, next we're going to introduce a couple terms here. Spread, or sometimes it's referred to as a margin. Now, what is that? A spread or a margin is basically, it's a fee. It's a fee that only is assessed. If I spelled assessed wrong, email my brother Josh. Assessed against gains. A fee that is only assessed against gains. What does that mean? Well, let's say you have a 2% spread or a 2% margin. Then if the index does not perform, let's say the index goes down, so you don't lose anything, right? That 2% is not charged. That 2% is only charged if there's gain. So guess what? If the index did 2% for that term, for that year, if it's an annual point to point, right? Then you basically get credited 0. You didn't make anything, you didn't lose anything. Well, you wouldn't have lost anything anyway. If it only credited 1, you'd still only get charged 1. You wouldn't get charged the full 2 for that year. But if the index did 3, you made 1. If the index did 10, you made 8. If it did 20, you made 18. Make sense? So that's spread and margin, a fee that is only assessed against gains. Then what is a fee? Well, that's a fee that's assessed regardless. I'm not even going to put that as a separate crediting strategy here. It's a fee is something that's assessed no matter what. It's going to be assessed whether there's gains, whether there's losses, if there's losses in the index annuity, you still don't lose anything, but it's still going to be assessed. So even if, let's say, the market goes down and you have a 1% fee, you're still going to have to pay that 1%. So you didn't lose money based on the market, but you ended up having a negative balance because of a fee that year. And most of the time, those fees are going to be assessed if you have some type of an extra rider, like an income rider or some type of a death benefit rider. Most of the time, that's going to be the case, is when there's going to be some other type of a rider that's put on there where you're going to have a fee that works like that, where it's assessed regardless. Okay, so there's that. Now we're going to start getting into some pretty fancy crediting strategies, because now we're going to go enhanced participation rate. And I'm just going to abbreviate par rate. That's how we talk about it in the industry. An enhanced par rate with a fee or spread / margin. Anybody confused yet? Okay. An enhanced par rate with a fee or a spread / margin. So now what does this mean? That's some $100 words. And hopefully those of you that are geeky and able to follow along with how this works, though, can kind of start to understand how this is working. Let's use what we've talked about so far. Participation rate is a percentage of the index gain that you're going to get credited. So an enhanced participation rate for a fee means that we are basically buying a higher participation rate for that fee. That's kind of what that means. So what can that mean? Well, maybe we have a normal participation rate that might be 50%, but an enhanced participation rate, maybe for a 1% fee or spread or margin. I mean, you understand how those work now. Then that instead of 50%, maybe that gets you all the way up to like an 85% participation rate for that year. Then if you go 2 years, maybe remember how I said that if you go longer terms, you might be able to get better crediting strategies. So maybe in the 2 year, maybe for that same 1% fee or spread, call it, right? So now we have 2 year. I'm going to do a 2 year. This was the 1 year. Okay. 2 year fee, or can't spell spread. Yeah, spread. That might give you, call it 125% of the growth minus that one fee. Now you're starting to say, okay, hang on, Nate, how do they give you more than what the interest or the index actually did? And that's going to be, I think, maybe a topic for another podcast, because it's a little confusing, and it goes into how index annuities are even designed, the product development of them, and how insurance companies invest the money that you give them for the premium. So that gets super duper nerdy, and that's going to be beyond the scope of this episode. So right now we just want to talk about just the concept, because guess what? Insurance companies still make money, guys. And so 125%. So you're buying more participation in this index. So 125% minus the 1%. So over those 2 years, let's say it does 10%. So 10% times 125%, that means 12.5%. Minus the 1% annual fee. So that's 2% per year. So you got 12.5 minus 2. So you actually got 10.5. So if the index did 10, then you're going to get credited to 10.5 based on how that math worked. Now, that was applying the percentage rate before applying the fee. And some of them work that way. Some of them work the other way. They're going to apply the fee, and then they're going to apply the percentage rate to that. So if we did that, we might need a little bit more math. So there we've got a 2% fee because it's 2 years. So now that 10% that it did, we have to subtract that. So if we did the fee first, so 10% now becomes 8%, and 8% times 1.25 equals 10%. So we still got the full 10% credited at that in this case, right? We didn't get the 10 and a half, but we still got 10. And so not a huge difference, but a little bit of a difference on the timing of whether they subtract the fee first or the spread, first and then apply the enhanced participation rate, or if they apply the enhanced participation rate first and then subtract the fee. So it could work either way. So yeah, I think that pretty much gets the vast majority of all of the different types of crediting strategies that are available out there. And so now from, when you're working with an advisor, they need to have an understanding of all of these different types of crediting strategies and when they might want to use one over the other, and all of the different indexes that are out there, or indices, however you want to say it, right, that are out there, and understanding how each one of them work as well. So there's a lot that goes into choosing these. So hopefully this helped explain for those of you that were like, still no idea how the money in your annuity is made. Hopefully this helps clear some of that up. So now you can start looking at your annual statements and be like, okay, well, this one's got this participation rate and this spread, or this, cap, or this, and I'm in this one over here. And so you can start seeing those, and we can have, a conversation about that whenever we have our reviews, because every time we have a contract anniversary, that might be a chance to maybe use a different crediting strategy. Rates change all the time, and you might have a rate increase here but decrease here, and so it might make sense to switch out of something that could possibly work better. So that is it. So that's a deep nerdy dive. Once again, I apologize to those that were listening only on audio and did not get a chance to see that. But if you want to see that, go over to my YouTube channel, the Retirement Rescue Radio YouTube channel, and you'll be able to see that. So that's it, guys. Thanks again. Just trying to continue to bring you more information to help you, empower you to live the retirement you deserve. Take care, and we'll talk to you next week.